We have to learn new tricks all the time, yeah? And this is side by side, this way. So this is how you will see now. Okay. All right then. Let me zoom in a bit. Okay. Let me talk about first leverage analysis. Yeah. Leverage analysis. Leverage E is missing. Leverage analysis. What is the meaning of the word leverage? Yeah, we need to understand this first. What leverage means. Now, American textbooks usually use this word leverage to mean like borrowing, but borrowing is only one of leverage analysis. So when you read some American web page or you are reading an American textbook, they'll say, oh, this company is leveraged. That means this company has borrowed money. Yeah. But leverage is not just about borrowing money. Leverage is about managing the fixed costs of a business. Yeah. So leverage is actually this. Yeah. Meaning of leverage is the responsibility of a business to pay fixed costs. So there are two types of fixed costs. Yeah, two types or two categories, not two types, two categories of fixed costs. You have operating so this results in what we call degree of operating leverage. How much of fixed cost does a business have? If the operating costs are very high, a lot of fixed costs, a lot of fixed rental to pay, a lot of fixed salaries to pay, a lot of fixed costs in the operations, then we will say the degree of operating leverage is high. The higher the proportion of your fixed costs in your business, the higher will be your degree of operating leverage. Yeah. And let me call this DOL, short, yeah, degree of operating leverage. Then, of course, you will have financial costs of borrowing, fixed financial costs of borrowing. That means your loan repayments, isn't it? Yeah. That is also fixed because you cannot tell the banker, sorry, we didn't have good business this month, so I pay you less. Cannot. The banker will want their installment. So that's why it's a fixed financial cost. And that's why some people think, oh, leverage is only about borrowing. No, borrowing is what people can see easily. It's more visible. Yeah. So this results in degree of financial leverage, we say. Yeah, degree of financial leverage. Leverage, and we call it DFL. So two types of costs, two categories of fixed costs. Your fixed costs can be in the business operations, or you can get fixed costs because you borrowed money. When you borrow money, for sure, the costs are going to be fixed. the cost of repayment of the loan. Yeah. So when we do a planning, we want to find out how much will be the fixed cost and the variable cost, and how will it affect our profit. Yeah. So the important thing to know is fixed costs can have a negative impact on profits, because we have to sell a lot before we can cover the fixed cost. Whether you sell or not, you have to cover the fixed cost, isn't it? These costs must be fully covered before the business can use revenue. Revenue means sales income. Yeah. These costs must be fully covered before the business can use revenue to cover variable costs and make some profit. So let us look at a projecting or preparing budgeted profit statement. How do you do that? In order to prepare a budgeted profit statement, we need at least the 6 following items of data. 6 things you need, then you can prepare a budgeted profit statement. So if you all are talking to any business friends or whatever, you can tell them, after today's class, I can do a budget for you. I can do a budgeted profit statement for you. Very simple. First thing you need is selling price of 1 unit of your product. Let me say this is $45. RM 45, let's say. Okay. Secondly, you need the sales volume of units projected to be sold during this period. Yeah, usually we do for a year. Yeah, so let me say selling price is this, and sales volume, I want to sell 1000 units. Simple. 1000 units here. So what will be my total in sales revenue? Yeah, my total sales revenue. How much? Tell me. Selling price of 1 unit is 45. We're going to sell 1000 units. How much is your total sales revenue? Don't use calculator. Think. 1 unit 45. 1000 units. Come people, talk to me. If one unit is 45, 1,000 units must be 45,000, isn't it? Don't you think?
Yes,
Yes.
sir.
Apa ni duduk diam saja 45,000. Yeah. Yes. Okay. So those are the first two things you need. The good news, yeah. Then you need to ask yourself, how much is the level of variable costs? Yeah. You need to know the percentage of variable costs. Um, Not fixed cost now, variable cost. Why? Because you produce more unit, you will incur more variable costs. You need to use more raw material. You need more stuff, isn't it? More packaging, more distribution, all these are variable costs. Yeah. So you might get percentage of variable costs. Uh, Let us say for this company, percentage of variable cost is 60%. So we will say total variable cost be equal to 60% of the sales to 60% multiplied by 45,000, 27,000. We make sales of 45,000, but 27,000 is our variable cost. Now, sales minus variable cost is called contribution. This is something you need to know, yeah? Sales minus variable cost, we call it contribution, equals contribution. Contribution profit. New word, contribution profit. You have gross profit, operating profit, this, that, and the other. Now this one is called, let me put it here, and let me put it like that. Sales minus variable cost is contribution profit. Jadi, sales 45,000 minus 27,000 is 18,000. But remember, this is variable cost only. Yeah. So this is the profit before charging the fixed cost. We haven't charged fixed cost yet. Only the variable cost. Yeah, before charging fixed costs. Now, if I told you that fixed costs, fixed costs were 10,000. Yeah. So that is the fourth one you need. Yeah. Fixed operating costs. You need both type of costs. Yeah. And you need fixed financial costs. Let us say fixed operating costs were 6,000. Fixed financial costs were 4,000. So jumlahnya total 10,000. Okay. Then you will get what? You will get profit before tax, isn't it? Yeah. You will get profit before tax will be contribution minus all these fixed costs. Then you get normal profit before tax. Yeah. Then the fifth one you need, well, this is 4 and 5. And then the sixth one you need is the tax rate. Yeah. Sixth item. I told you 6 items of data, yeah? So the applicable tax rate company, let us say it is 20%. We put 20%. 20% give to the inland revenue. Yeah. Can become percentage. Cheeky bugger. 20%. Okay. Or if I put like this 20%, enter, then control X. This one here, nice. I like it like that. Neater. 20%. So how much will be the tax paid? Tax to be paid, because this is a budget, yeah? Tax to be paid will be equal to 20% multiplied by 8,000. Give us 1,006. Well, so you know what is profit before tax is 8,000. Tax to be paid is 1,006. So you get net profit after tax will be equal to 8,000 minus 1,006. You get 6,004. Okay, 6,004. Now, this is how you do a projected financial statement, yeah? So in the exam, I will give you all the information. This information that you see here, I will give you. You must work this out. You must fill in the blanks here. And once you have done that, I've already uploaded to your BLMS, by the way. So, but it will become active only on Thursday. Then you do what we call the leverage analysis. So your leverage analysis will work out like this. DOL maybe I need another line. Sorry, yeah. So let me just move all of this down. Okay. Because I didn't take the most important number. Getting old, I guess. So you get fixed operating cost 6,000. Let me put this 6,000 here. Yeah, 6,000. Then that will give you, we call it earnings before interest and tax. Yeah, EBIT. Yeah, EBIT. This is called earnings for interest and tax. EBIT. So if I just take 18,000 minus 6,000, yeah, sorry, then I will get EBIT equal to how much? 18 minus 6,000, 12,000. Then this one is not 10, this one is 4,000. Fixed financial cost. Then I get profit before tax, but same thing. I still took 10,000. Only thing I break it up first so that I got another profit level, which is called EBIT. EBIT is lebih kurang sama. Sorry, EBIT is more or less the same as operating profit. Yeah, it's like an operating profit, but we call it earnings. Earnings here means profit. Profit before charging interest and tax. So now I charge interest and then I charge tax. So this is a management accounting way of presenting a financial statement. You see, How did we prepare this budgeted statement? Let's just go through the items one more time. Yeah. uh, we got the selling price multiplied by sales volume. Yeah, how many units we sell? 45,000. Then we say, okay, to earn this profit of 45,000, we produced 1,000 units. What is the material we used for producing this 1,000 units? How much did it cost us to advertise this, to distribute it, to pack it, to send it to the customers? And we say more or less for from the selling price 45 ringgit, we are able to get 40% profit margin. Yeah, our profit margin is 40%. So that means your variable cost is 60% now. Yeah, we also call it contribution margin because contribution is also profit. Yeah, so anyway, in this example, 45,000 was our total sales revenue for this week, this month, whatever, and the variable cost was 27,000, so that we got our contribution profit to be 18,000. Yeah, for this batch of 1,000 units. From 1,000 units, we got 18,000 profit, but we have fixed costs of 6,000, fixed operating costs which we must pay, salaries for that period, for that week, for that month, yeah, or for that day. So when I put the fixed operating cost 6,000, I get EBIT, or earning before interest and tax, 12,000. Then I get fixed financial cost 4,000, interest that we pay, our loan repayment. This one is total loan repayment. Yeah, total loan repayment. I get profit before tax 14,000. The tax which we have to pay, you cannot run away from tax, 20%. So that is 2008. Therefore, the net profit after tax 11,200. So now we can do leverage analysis. Leverage analysis is to measure sensitivity of our sales. So we want to ask ourselves, now this is the sales we are going to earn. How much we are going to earn? 45,000. We want to ask ourselves, what if our sales revenue goes down by 1%? How will it affect our profit? Yeah. So how will it affect our operating profit? How will it affect our net profit? And I told you that the fixed costs are two types of fixed costs, isn't it? Operating fixed costs, we call it DOL, degree of operating leverage. Fixed financial costs, the borrowing costs, we call it DFL. So we can actually apply a formula, a very simple formula. So degree of operating leverage DOL is equal to EBIT, earnings before interest and tax, plus fixed operating costs divided by EBIT. That's the formula. It is cleaner a bit. Yeah, degree of operating leverage. I put the equal sign here. EBIT plus fixed operating costs um, uh, divided by EBIT. So in our example, in our example, what is the EBIT? EBIT is equal to how much? 12,000. Yeah, 1,000. Let me just put it like this so that when you look at it, you know where I pick up the number from. Yeah, it's 12,000. Fixed operating costs. Fixed operating costs. Operating costs are equal to fixed operating cost 6,000. Yeah, so we can say therefore DOL is equal to 12,000. It gets like this: 12,000 plus 6,000 divided by 6,000. Yeah, and that's equal to 18,000 divided by 6,000. Yeah, and so that's equal to 18 divided by 6 times. Yeah, we say 3 times, 3 kali lah, DOL. Then we need to work out DFL, degree of financial leverage. D of financial leverage is very useful. You will see what it actually means. Yeah, and I will explain what it means. Yeah, very, very useful calculation. DFL is equal to, I must give the formula first, isn't it? It is EBIT divided by EBIT minus fixed financial costs. Yeah. So this divided by this. That's the formula. So in our example, we already know what is EBIT. We just need the fixed financial cost, isn't it? Yeah. So fixed financial costs are equal how much did we say we are going to pay? Fixed financial cost, there you go, 4,000. Okay, so then DFL, yeah, DFL is equal to EBIT, which is 12,000. Yeah, I can again use brackets, 12,000 divided by, in bracket, 12,000 minus 4,000. That is equal to 12 divided by 8, isn't it? Yeah, 12 minus 4 is 8, 1.5 times. So you see, we got degree of operating leverage to be 3 times, degree of financial leverage to be 1.5 times. We will say therefore degree of total leverage, and that's where the analysis comes in. Therefore the degree of total leverage, we call it DTL, of course. Yeah, equals DOL multiplied by DFL. Yeah, multiplied by. So in our example, um, DOL was 3 times. FL is 1.5 times. Therefore, um, DTL equal to 3 multiplied by 1.5, that's 4.5, multiplied by 1.5, 4.5 times. So what does this 4.5 times means? Yeah, meaning if a company cannot achieve the budgeted sales yang 45,000 tadi tu, the 45,000, if the company cannot achieve their budgeted sales and they are 1% short of their target, they're just 1% short of their target, then net profit after tax will be 4.5% lesser than target. For every 1% that the sales is lower than target, profit is 4.5 times lower. So if sales is 2% lower, this one will be 9% lower. If sales is 10% lower, this will be 45% lower. Yeah. So for example, if sales are 5% lower than net profit after tax, net profit after tax will be lower by 5% multiplied by 4.5%. Yeah, 4.5, which is equal to, because it's times 1, yeah, DTL is times, so that's equal to 5 times 4.5, and that's 22.5% lower. Your sales are 5% lower, profit 22.5% lower. So it tells you, if your budget. Now, sometimes companies say, oh dear, what is our break even? Can we measure break even? Yes. Break even change in sales revenue can be measured. Break even. Can you tell me what's break even? What do you all understand by break even? Come, please talk to me. What's break even? Break even? Break even means no profit, no loss. That means when the net profit becomes zero. Right now, we said that if we can achieve this budget, Yeah, if this is our plan, our selling plan, we will sell 1000 units for 45 ringgit. We'll get this variable cost. This will be our earnings. This will be profit before tax. Net profit after tax will be 11,200. So break even means I want to ask the question, how many percent will this sales revenue fall before my net profit after tax becomes zero? Yeah, how many percent must it fall? Well, uh, that means for it to become zero, uh, break even can be measured by fall in net profit after tax, da, 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 net profit after tax by 100%, isn't it? I.e., it becomes zero. So break even equals 100% divided by DTL. That's all. That's a shortcut. Yeah, that's a shortcut. So how much was my DTL? 100 divided by 100 DTL ni. There, 4.5 times. So I get 22.22222%. Yeah. So you know what we are saying here? That all other things being equal, if the sales fall by 22%, no more profit already. Oh, important information, right? The businessman needs to know. Yeah. If sales revenue falls by 22.2%, the net profit after tax will become zero. Okay, I know there's a lot to take in. Huh? Now let me take it from the top again. Okay, we said we want to budget our profit statement. We will sell our product on average 45. If you have a few products, you can take the average price, yeah, and then you just total the sales volume. And so in this case, simple example, I said, well, sales volume is 1000. The total sales revenue we'll get is 45,000. Then I asked, okay, how much are the variable costs? Because 6 items of data I need. I need the difference between fixed costs and variable costs. Now you see how important it is, yeah, to measure the difference between fixed costs and variable costs. So the question 4 in your exam, it's a simple one. It's just you break up into what is fixed cost, what's the variable cost, what are the different scenario. That's all. So I want to see whether you can think about it or not. Yeah, I'm not going to give you any clues for that now. Yeah. Anyway, come back to this. Yeah. Total sales revenue 45,000. The total variable costs for 1,000 units is 60% of sales. That's 27,000. So we make what we call a contribution profit of 18,000. Then we say, wait a minute, our fixed cost of the factory, our operating costs are 6,000. So that leaves us 18 minus 6, only 12,000. And then we pay our banker loans of 4,000. So which means that leaves us profit before tax. Oh, I'm very sorry, this should be 12 minus 4,000, 8,000. And the tax rate applicable is 1,006, so that the net profit after tax was only 6,004. Yeah, only 6,004 net profit. Now to analyze this, we want to know if you can meet your budget you will make profit of 6,004 if you can meet your budget. What if you cannot meet your budget? What if you cannot sell? That's the biggest risk, isn't it, in business? So in our example, we said that EBIT is 12,000. Our fixed operating costs were 6,000. And so our degree of operating leverage was 12 over 6 was 3 times. And degree of financial leverage was 12,000 divided by 12 minus 4,000, which is the fixed financial cost, 1.5 times. This doesn't change. So that if I want the total leverage, I will take 3 times 1.5, which gives me 4.5 times in this case. What does this 4.5 time means? It means sales goes down 1%, profit goes down 4.5%. Another 1%, another 4.5. And maximum, this can go down is 22.2%, because if it goes down by 22.2%, this will be go down by 100%. When your sales falls by 22%, profit will fall by 100%. That means become zero. So what is the break even? The maximum that your sales revenue can fall is 22% break even. Very good analysis, isn't it? Yeah, very useful analysis. So I will put this up on your WhatsApp for you to practice. Change the numbers, try to practice a few times. And if you have any questions, of course, I'm just one WhatsApp message away. Yeah. So this is question one for you. Question one for you, this topic. That's why I wanted to have this additional class. Also because I think one of our classes was affected by a public holiday or something like that. So well, there you go. Yeah. A very interesting topic. Leverage analysis. Any questions at all? Any questions, people?
No question.